That's probably a natural shoehorn into capital allowance.
It is, yeah.
Not really my area, so I'll happily bow to the greater powers on this one. So, over to you on capital allowances, Dave.
Yeah, so again, we've obviously got if we're looking at sort of capital gains tax allowances and stuff, a nice one that we've had there where we had a 4% drop in the higher rate for capital gains. So when you're selling, say, a second property, or you're selling a taxable item that's a property, you would have paid 28% on anything that's over or into the high rate band for tax. That's including your actual income tax income as well. So the fact that they've dropped it by 4% is nice. It's still not brilliant, really. I think we're probably going to do a bit more with that, because again, but then I can see that they are trying to sort of bring in trying to stimulate the property market again. I think that's the key thing.
Most definitely.
Yeah. They're not.
I read, I think, house sales and purchase were down 15% in 2023, which is a pretty staggering number. Obviously, the amount of companies that are involved in, the sale and purchase of properties and all the subsectors surrounding it. It's the biggest mover of money in the UK market. So it's always. We were saying, it's difficult because with property, they want it to grow, but they don't want it to grow too much. And if it grows too much, and first-time buyers can't afford it. If it doesn't grow enough, makes it difficult to roll out any sort of tax changes or stimulus. So that's sort of the Goldilocks of taxation and property growth, really.
And again, that's another thing that of interest was the removal of furnished holiday lets as well, the allowances. Again, I know it's going to simplify it, but it also means that they're not going to get those allowances. It's not going to. It almost pushes the viability of those furnished holiday lets out of the window, really. And again, it was a nice bonus to have, but again, it was always a case of how long is this going to last for, because you knew at some point that the government was going to go after it, really. And that then frees up more of the properties in those sort of rental holiday market areas, sort of like the Devon and stuff like that, and Cornwall.
Realistically, no one locally is going to go out and buy. If you a one-bed flat in Cornwall for £800,000, it's definitely not going to be in the locals market.
That's the thing. You're looking at it, thinking, well, I know the area you guys are trying to sort of stimulate, yet the locals aren't going to be able to afford that. And in fact, even some of the people in the surrounding areas aren't going to be able to afford it. I'd be surprised if anyone from outside of London could actually even afford to buy a property in there. I think that's going to be pretty much a damn squib. Although, again, the idea of trying to stimulate it with the drop of the 4% drop, it's still not going to be brilliant sort of thing. And again, I still think that you're going to have a nice little shoehorn into the non-dom regime replacement as well. Again, I think a lot of the property owners are offshore, and the idea that they're going to replace it in April 2005 with a new option as well, where after 4 years, it's you're looking at the removing the remittance basis, i.e. when you bring the money into the UK, that's when you get taxed. It's actually going to be, you have 4 years, tax-free in the UK, and then you're going to look at being taxed on your actual income or worldwide income. Again, I think that's lending itself more back to the MTD for ITSA and stuff like that. So they're going to have to find ways of monitoring and recording it and policing that as well, which, again, it'll be interesting how they try to do that. So I'm just thinking about it. Do we look at sort of what wasn't covered by the budget? I saw the stuff that he didn't bring to. Obviously, they're still halving the capital gains. Dropping 6 to 3.
This is a big planning point. I've been having this conversation a lot with clients lately. To me, so capital gains tax exemptions historically were £12,000 a year, gone to £6,000, going down to £3,000. And give it a really basic example. If you've got a direct share that you hold, £100,000, if that share increases up to £103,000, you're going to be into capital gains tax territory, which is really, really low, and it doesn't give a lot. You're talking about a 3% return now. The stock market last year, on average, is probably up about 10% for the year. In an average sort of medium risk portfolio. So that would have pushed the average investor with £100,000 straight into capital gains tax. I think the importance of tax wrappers, the structures that people use for their investments going forward is going to be really important. Between now and the end of the tax year, capital gains tax management, so what can you do about it? Well, if you've got a portfolio, an unwrapped portfolio, a unit trust, an OIC, a general investment account, varying different terms out there, but if you hold one of those types of investments, if you've not looked at any fund switches to trigger those capital gains, now's the time to do it. Even selling down a fund into cash and then going back into that fund after 30 days to avoid your bed and breakfast rules. Something like that. If you've not obviously utilised your ISA allowance and you hold unwrapped investments, I would like to think that everybody would be doing that as a sort of just natural tax planning. But in making that sale from a general investment account down to an ISA, you're crystallising gains at the same time. So I think the opportunity to try and use that £6,000 exemption now, ownership of those investments, if it's if it's an investment in single names versus investment in joint names,
you got
one set of capital gains exemptions versus two. Whilst this is all sort of very fund focused, it's amazing how many people own rental properties that are just in a single name and have not necessarily considered moving that asset around between spouses and partners. So I think they're all options to consider. I think the biggest thing, though, is going into next year with this £3,000 exemption, it's almost the opposite. That, if you're looking at a portfolio and you're looking, say you've got a £150,000 investment portfolio, you go to make a fund switch, make a change to that portfolio, it's going to be really, really easy to inadvertently trigger a gain. It won't have had to have grown by much, and all of a sudden you're going to be stuck with a capital gains tax bill. From a planning perspective, there is no one-size-fits-all answer on this conversation. It is just engaging with your professional engagement, whether it's a financial advisor or a tax partner, accountant, whoever you work with. These are the type of conversations you need to be having with them and making sure that there isn't any inadvertent gains, because capital gains tax can be quite a complicated, particularly where you've got a portfolio that's been chopped and changed and switches and movement of funds. It can be quite difficult to keep a track of that. So I just think it's something we've really got to watch. The only tie I'd make to the change to the higher rate of property CGT down to 24% is that I wouldn't be surprised if we had future changes in governments and CGT was on the cards. It's one of those things that in the run-up to most budgets, CGT gets put on the table, and it wasn't that long ago that we were talking about aligning it with income tax rates. We should see you having a maximum rate of CGT going from 28% to 45%. So to me, I still think, maybe opportunistically in the next tax year, if you were going to offload a property anyway, if you were looking to sell, that actually doing that in the next tax year where it is slightly less, because most property gains probably are going to be in higher rate tax, that is the time to maybe take advantage of that. I don't think it's enough to go out full sale and decide to offload a load of property. If you were trying to move one on anyway, it'd be a better time to do it than not. So